Yeah, absolutely.
Excellent. And, yeah, since you're up there in the UK, I'd say you'd be missing out on the Spanish weather lately. But I don't know if you've been following the weather here. It's like we get Northern European.
I was in Spain for the last week and a half with Mobile World Congress and everything else, and got all the rubbish weather. I actually came from the UK and got worse weather in Spain. It was unbelievable.
Yeah,
It's beautifully sunny in the UK. It's ridiculous. Anyway,
it's sunny today and like I think like 12, 13 outside. We have Northern European weather and Southern European salaries at the moment, which is not ideal, but you know, again, it will change. We should have a good summer, and given we're not weather experts at all. But to everyone joining, we're just waiting a couple minutes for others to hop in. I hope you don't mind our banter while we go back and forth here to allow people to join in. And again, if anyone's joining, they have to leave early. We're going to send out a copy of the recording this afternoon once we get that done. But yeah, so like yeah, here in Barcelona. So we're based in Barcelona. I think Entrechemites, you're based here. You have your headquarters here in Barcelona, but with a little bit of a global presence around. Oh,
yeah.
I think yeah, here in Barcelona, like I don't know, like it's been so weird, just like weather-wise, and it's like messed with the rhythms too, because everything here in the city is about going out and like the social life, but it's really hard. And you know, I do a lot of events, and it's really hard to plan these because people tend not to go outside when it's all gray and rainy.
We can get away with gray and rainy being indoors on a webinar. That's at least one of the advantages.
Exactly. I can't be on a terrace right now doing this, which I suppose I wouldn't do, but you know, maybe one day. So we'll see how that goes. But yeah, like, and then it's so funny here is like, you know, if you come from like Northern Europe and you move here, sometimes you have to put like that mentality back in when like the weather's bad to like go out and either go to an event or like my favorite thing to do is on a Saturday when it's raining is I go out and do my shopping because no one's going outside when the weather's bad. You get the stores kind of to yourself, or well, less of a weekend crowd. So just another minute or two, and then we will kick this off.
And we'll kick off.
Yes. Yeah, really looking forward to this, and yeah, I think there's a lot to go over. I mean, tax season in Spain starts officially April 1st. Is that?
So there's two different things. There's the tax season for that, but there's the filing deadline for the Modelo 720, which is on the 31st of March. So if there's anybody watching this who hasn't filed their Modelo 720, technically we're not meant to be taking any more clients at this point because we're very close to the deadline. But we will be, if people can get all their paperwork prepared and together, we will be taking clients who need to do a last minute 720 filing. For those who are watching before we kick off, that's the informative filing, which you need to make if you have more than 50,000 euros of assets overseas and you were tax resident in Spain last year. So if you haven't filed that yet and you need to file that, that is due by the 31st. It is not a tax filing, but it's an informative filing you need to do. Later on, we'll touch everything to do with taxes, but in case you are in that position and didn't realize you need to declare your overseas assets, yes, we'll be open for any questions on that.
Indeed, it's a tricky one because it's related to taxes. It's going to the same office, but the deadlines are not at all the same, and it's it can be confusing, I'm sure.
Yes, and they also made changes this year where some tax deadlines were switched for non-residents to be January rather than June. So the non-resident 210 switched their deadline to January 20th this year.
Wow, wonderful start to the year.
So people might already be late. If their employer has not withheld correctly their payslip, it's possible they may be late on that one, unfortunately.
Right. To go into a little bit better news, I figure we've had a few minutes to let everyone join in so we can get this one kicked off. Thank you all for joining us who have been able to make it today. My name is Elliot Locke. I have Louis Williams with me, and we are here to do a little webinar on how to get your Spanish taxes ready this year so you can concentrate on your wealth building goals. And just to tell you a little bit about the speakers, I have with me the wonderful Louis Williams, the CFA, who is the co-founder and CEO of Entrechemites. And I really hesitate to pitch people's companies, but if I could do the elevator pitch for them, Entrechemites is everything about filing and interacting with the government here in Spain, mainly taxes, but not just taxes, to make this a much easier process. They exist because the government makes it difficult to do anything here. So it is a super cool service. We've been collaborating together for a couple of years now. Really excited to have them on board as a partner. And of course, I love chatting with Louis. For all of you who are joining us as you're waiting for people to come in, we had some nice banter going back and forth about anything related to money. Myself, I'm the co-founder and CEO of Abroadin. We are a financial well-being and education platform for people living abroad. So anything related to money, to building wealth, to understanding how that works, not only from a money perspective, but also how that can relate to you when you live and work in different countries. That's our wheelhouse. We don't handle the taxes ourselves, but that's why we partner with some excellent providers who can, and we talk about the longer term planning and aspects of that. So for today, how we're going to do this is I'm going to turn over the presentation to Louis, who's going to go through some amazing tax tips for filing this year if you're a resident in Spain, everything you want to know just to make sure this is as painless process as possible. And after that, I'm going to go over some of the different pension plans for foreigners here in Spain, crucial part of your long-term wealth building goal, but even the Spanish don't understand these fully. So I figured, we can go over these in detail a little bit here to explain how that works. There'll be time for Q&A. I think we'll do it through the chat. And then afterwards, we have a couple special offers, and we will be sending out a copy of the recording as well as some presentations and some other information via Luma afterwards. So with that, Louis, I'd love to turn it over to you.
I'm just going to do one thing very quickly because I just realized that in order to share screen, I don't actually have the share screen power passed on your side. So what I'm just going to do is I'm just sending you an invite to the presentation. And if you just go into Google Mail and just pick that up, it should be with you just then. And if you can switch across to that, and we can kick off.
Perfect.
Classic technical issues. While Elliot is running through that, I'll just add a little bit of detail. Why am I talking to you? What on earth is this about? I'm Louis. I am one of the founders of Entre Trámites, and as Elliot said, we're the place for everything boring in Spain. So if it's accounting, if it's legal, if it's immigration visas, if it's anything that you need to deal with the Spanish authorities, we're here and happy to help. If it's interesting, we will not touch it or deal with it. But if it's boring, we're here to help. So what are we going to be talking about today? We're going to talk about how Spanish taxes are going to affect potentially some of your wealth building goals. As we're well aware, investment management is a very delicate area where I need to be very careful on what I touch on. So while I will not be advising you whether you should be investing in Berkshire Hathaway or Apple or Tesla, or you should be digging everything and putting it in a hole, I'm going to leave that more to Elliot on the financial education part. I'm going to be here to be talking on how those investment decisions and how those different your different aspects of living in Spain should be affected by tax. So what are the tax considerations you should have when we get involved? Now, to begin with, I'm going to give you a brief overview of the tax situation, the general taxes which you pay in Spain, and the tax deadlines that we're coming up to. And then we're going to open for Q&A and other questions you guys may have, and open into a bit of a format where Elliot will be firing back and forth, different questions which we think will be relevant for you guys. So, next slide, please. Okay, basic concept. What happens if you live less than 183 days in Spain? And let me add a caveat. And a significant amount of time in another country so that you are viewed tax resident in that other country. Okay. If you live less than 183 days in Spain and let's say more than 183 days in another country, you'll be considered tax resident overseas in almost all cases. What does that mean? If you've been working in Spain, you're going to pay 19 to 24% income tax on Spanish salary. Why is it 19% in some cases and 24% in others? If you are living within the EU, or outside of Spain and you're a tax resident there, you will pay 19% withholding tax. So let's say you were living in Germany for the first half of the year, and then you moved to Spain as of September, and were working a contract from September to December. What could have happened? You could have been doing your tax filing and your employer didn't withhold any income tax because they were treating you as resident. Actually, that income you need to declare back in Germany, and in Spain, you should have been paying a 19% withholding tax. Alternatively, let's say you'd moved from the US and you were here, let's say you were here for January to March of last year, and then you left and moved to the States. Well, actually, you should have paid a 24% flat rate of tax on that income. Now, if you're in the position of having been non-resident for this year, for the previous year, but you had some earnings in Spain, If you did not have the correct amount withheld, then you should have made a filing by the 20th of January. If you're not yet filed, then you're going to need to do a late filing. Now, if you do it yourself, the fines are very small. If you wait until the Spanish government now come and tell you, hang on a second, you haven't filed either the 210 or the 100, pay us, that's when you're going to end up with more significant fines. So my recommendation would be clear that up very quickly if you did move to Spain and you were employed for a few months and they incorrectly withheld income tax. Then, in terms of rental income, let's say you're overseas and you've got a property in Spain. There are two different parts. There's 24% if you're outside of the EU, 19% if you're within the EU, which is charged on the Spanish rental income which you earn. And there are no deductible expenses on that if you are outside of the EU. As such, let's say you had a property which made 10,000 euros of rental income last year, you would need to pay 2,400 euros on that. And then back in your home country of tax residence, you would get a tax credit in most situations for the taxes paid in Spain. And if you were meant to pay more than 24%, you would pay the difference. So if you were meant to pay 30% in your country of residence, you would pay the 6% difference. Finally, on dividends, capital gains, and interest, you would need to pay 19% in Spain. Now, what is the other thing to be delicate of? If you were not tax resident last year, but let's say you moved to Spain and you bought a property in Spain, there's a thing called the imputed rental tax. What this says is that for second homeowners and those who are non-resident, there is a small theoretical rental value for your property for all the months you owned it while not being resident. And it's very important to pay this tax. Now, this one is only due by either June 30th or December 31st. I'm not certain, actually, just quickly off the top of my head here, for the imputed rental tax. That one did not have the January 20th deadline. They changed deadlines this year, which has emerged a little bit of confusion. This tax works out as approximately 0.2% of the value of the property. So if you bought a property for about 100 grand, you would have a tax bill of approximately 200 euros per year. Yes, 200 euros per year. If it was roughly 1 million, it'd be roughly 2,000. Now, it varies slightly because it's technically calculated on the cadastral value with a few different adjustments, but as a ballpark figure, imagine about 0.2%. So if you owned a property and you were non-resident last year, remember to file that tax. Now, what's the more likely situation for those who are here? Probably the second situation, which is the next slide, which is, what happens if I live more than 183 days in Spain? As you're a Spanish tax resident, you are going to pay a variable income tax on global salary. What does that mean? If you were working overseas for any of last year, you will likely have withholding tax in the other country. So let's say you worked in Germany for 2 months and then moved to Spain. Those earnings most likely will need to be declared in Spain. There is a small exception called exemption 7P, which is if you had employment earnings outside of Spain worth less than 60,100 euros, you do not need to pay tax on those earnings, provided that they were employment earnings and you paid the relevant tax in the other country. That is a small exception, but the general rule is all of your overseas income, self-employment income, whatever, is taxable in Spain, and you get a credit for the tax already paid in the other country. Same with overseas rental income, overseas dividends and interest. Now, this is one of the areas which people are often unaware, but most countries apply withholding tax on dividends and interest. So let's say you've got stocks and shares in the US. Under the dual tax treaty between Spain and the US, US companies withhold 15% on dividends for non-US nationals. So you're actually paying a 15% dividend tax to the US, which if you forget to file and pass on to your tax filer in Spain, when they then go to present your taxes, you will be paying 21% without claiming the 15% credit. So you should have been paying 6%, but maybe you might end up paying 21% on these dividends. Okay? So this is a very important trick to always remember to include withholding taxes which have been paid in the country of origin. Now, usually withholding taxes are lower than the amount of tax which would be due in Spain. So normally, you will not have the situation where the withholding tax is higher than the Spanish taxes. If withholding tax would be higher than the Spanish taxes, you will owe nothing additionally in Spain under most dual tax treaties. Now, there are a few countries of origin of income where double tax treaties do not apply. However, the norm for most of the areas where you would have investments, rental income, or overseas salary would be that. So important thing to remember, reclaim withholding tax and make sure you have a record of whatever you've paid on it. And in terms of income tax, be aware you are taxable on your global income, your global rental income, your global dividends, capital gains, and bank interest. Critically, if you have UK or US listeners in today, if you've got a Roth IRA in the US, that income is taxable, the interest, dividends, and capital gains within it, even though you're not pulling any of the money out. If you've got an ISA if you've got an ISA in the UK, that is taxable on interest, dividends, and capital gains in Spain, even if they are not taxed in your country of origin. Okay. And if there are similar tax savings products which are not viewed as pre-tax deducted pensions, such as in Australia, you have I forgot the name of them, superannuations. So pre-tax, if you have post-tax superannuations will be taxable on the dividends, interest, and realized capital gains within them. Okay, so always check on your investment accounts to confirm if they are viewed as a pension asset or not pension asset by the Spanish authorities. Next slide, please. So, what's the general rule and the general things we're talking about? If you look at general taxation, if you're an employee and you've been working in Spain and everything else, you're going to have two different types of taxes applying to you. The Social Security fee, so this is a roughly 6.5% payroll tax on the employee and a 32% payroll tax on the employer on the first 60K. So one of the reasons why salaries might be a bit lower in Spain is because the tax actually charged to your employer adds a 32% cost to your gross salary, which sometimes we don't quite realize. And then outside of the Social Security fee, there's a progressive income tax. Now, one of the important things on the progressive income tax, which often ends up getting confused, is in income tax in Spain, and every euro you make additionally, you are better off. It's not like you cross a cliff edge and suddenly all your income is taxed at a higher rate. So broadly, income tax will apply in different bands, which I will go on to in a second, but it goes from around 19% up to around 47%, depending on the autonomous community. In Barcelona and Catalonia, it's more like up to 49%. In Madrid, it's more like 46%. It doesn't vary that much between autonomous communities, however much people like to talk about it as if it does. On the other hand, you've got self-employment. So with self-employment, you've got Social Security, income tax, and then I'll touch on the VAT side in a second. But basically, Social Security fee as self-employed is you've got a minimum contribution that you've got to make depending on your income level. Now, under all the complexity, actually, self-employed tax is in some ways simpler to estimate than employed taxes. Why? Social Security is a regressive tax. What does that mean? If you make, let's say, 15,000 euros in Spain, you pay 3,600 euros approximately in Social Security. Whereas if you make 150,000, you make around 7,300 euros in Social Security. So your income goes up tenfold, but your tax only doubles. Income tax does the opposite. Income tax on the first 7.5K is basically zero. And then on the next 5K is around 20%. Then the next 7.5K is around 24%. Then the next 5K around 27%. And very quickly, you'll see it scaling up. But when you combine these two taxes, what you end up getting is actually a very simple trajectory, which is Social Security plus income tax is basically 1 in 3 euros in taxes, up to around 60,000, and then it jumps to around 47%. So if you are self-employed, under all the complexity, it actually ends up being a pretty flat tax regime. Now, you might be thinking, okay, that's kind of get it, but I've heard of tarifa plena and this discount for the first year. It is true. There are two discounts available for the first year. One is Social Security is only 87 euros a month for the first year, which particularly for high earners is an advantage. And not particularly for high earners, actually for all earners is an advantage within that. The second part is that in your first year, you can get up to 20% capped at 20,000 euros of your income untaxed if it's a new economic activity. So if you've never been a freelancer before, they will only tax you on 80% of your income up to 100K and then they tax you full. So your tax rate will be a bit lower in your first year and second year. However, as a rule of thumb, just imagine 1 in 3 of your euros are not your cash. Okay? How is this paid? You've got quarterly taxes and annual taxes on this. In the quarterly installments, you'll pay 20% income tax. Your Social Security will leave your account monthly. And then when you get to your annual taxes, you'll pay the difference between the prepayment and what you're meant to pay. Now, one thing you're looking at there, you're thinking, but what about VAT? What's that? VAT is the sales tax, which you're very used to paying, either when you go to restaurants, bars, and everything else. If you are selling services to a business outside of the EU or a business inside of the EU with a VAT number, you do not need to charge them VAT. If they're a Spanish client, you do need to charge them VAT. If they are a retail client outside of Spain, so sell to a consumer, normally you will need to charge them Spanish VAT. There are some nuances and everything which we'll get onto in the yoga concept, in a yoga class concept I'll run through with all you guys in a little while. But the broad idea is there with VAT. Now, for limited company, it's very similar, except one of the critical differences is the limited company has their own tax form. And so one of the things you can do is you can split income between drawing it as earnings. So different to many other countries, in Spain, if you run a limited company, you are considered what's called an autónomo societario if you have more than 25%, which means you pay the same social security as self-employed. So any of you who think it's a way to save paying self-employed social security, it's not. Also, self-employed social security is cheaper than employer and employee social security in most cases, so it actually makes better sense. And with an SME, you've got the access to a thing called the splitting income between salary or paying receiving income which you take as corporate profits and then pay out as dividends. But we'll touch on that in a little while. Next slide, please. So personal income tax, basically, in general, it's an individual filing. Big difference for lots of Americans out there. You can do it joint. In general, it doesn't make sense. If your partner makes more than 6,000 euros approximately, maybe slightly higher if there are kids and everything in the mix, might be 7, 8K. But if they are making less than 6K, it can make sense to do joint filing per year. If their earnings are above this, in general, it's better to do individual filing, because when you combine people's tax filings in Spain, they don't add up your allowances. They actually just add a small bit of the tax-free allowance, but they make you jump into the thresholds quicker. So it actually can lead to a higher tax bill if your income is basically less than 6, 7K. Now, what are the required documentation? Information on any sources of income you've got. If there are any expenses that you had which were deductible, this is mainly to do with the self-employed and everything else. And if you have income from overseas, any documents to show withholding tax in the other locations. Next slide. We basically split how we deal with income tax returns into kind of a basic return or an international return. The basic return is just a flat priced service, which we do at 61 euros plus VAT, roughly 74 euros. If you only have income from within Spain, you don't have international cross-border withholding taxes or anything to claim. And then international income varies. It's up from about 67 euros plus VAT up to, depending the complexity, can be a lot higher, but usually we're talking about 120, 130 euros. And this is basically because of the hassle of dealing with all the double tax-free claims, which lots of accountants in Spain fail to do. So that's one of the big reasons we deal with it. Next slide. So when are the filing deadlines? Right. You can start online filing from April 2nd. So the tax system should be live on April 2nd, assuming nothing goes wrong. So Spanish government could mean April 3rd or 4th, because you never know what happens. For those of you who don't know, the system for registering new companies and new self-employed people was meant to be shut for routine maintenance for 3 days, and it ended up being shut for a month and a half. And this system, because they shut this, it ended up meaning that people who were setting up companies had to pay notaries 1,000 euros instead of paying about 150 euros if they wanted to avoid using the system. So I wonder who had an incentive that never got properly set up. So the mercantile registries and the notaries made an absolute killing for about a month. Anyway, this is just my inner cynic coming out. So the online filing on the income and tax returns, April 2nd to June 30th. You can do it by telephone. Honestly, I don't really recommend it. Telephone responsiveness is rubbish, and it doesn't tend to work very well. That's May 6th to June 30th. You can also do it in person, June 2nd to June 30th. Now, one thing to be clear on, you go to a tax filing with the tax authorities, that gives you no protection on them then querying it and giving you a fine. It doesn't matter that you do it with the literal tax agent looking to help you or anything else. It does not help anything. In general, we highly recommend using the online filing, and you can file yourself using a digital certificate. However, if you have any complexity on your tax returns, or you want to see if there are some breaks you can have available, people usually look for assistance, particularly if they have overseas income. Overseas income is the critical area where things get complicated, and it's easy to make mistakes, and the Spanish authorities are not exactly the most forgiving in this world. Next slide. Now, one thing is the wealth tax, which if you guys have been building up a more significant portfolio, I'm using the example of Catalonia, but it varies by region. If you have more than 500,000 euros of assets and you live in Spain, excluding up to 300,000 euros for your first home, you will need to pay a wealth tax. Now, if you've got 1.2, 1.3, 1.4 million of assets and 300K of that is in the house, this tax is not going to be too significant. But if your taxable assets go up above 600, 700K, this can very quickly start escalating into a more significant tax outlay. However, it's not usually worth doing much tax planning until and looking at potential alternatives until we're going probably about 2.5, 3 million upwards. If you have assets above 3 million, I would consider, and you're considering where to locate in Spain, consider whether you might have interest in some of the regions which have suppressed the wealth tax up to 3.7 million. So the critical areas where they've suppressed it to 3.7 million, i.e. tax doesn't apply, is now Cantabria, Madrid, Andalusia, Murcia. I think Extremadura has just added themselves to the list, but I need to verify that. And the Balearic Islands have got 3 million exempt because they made a mistake when they were copying the exemption in passing the law. And then after they passed it, they couldn't make the adjustment to change it back because politically it was too hard to go back to make a small amendment. The other thing which is interesting is maybe you're listening into this and you're out in Andalusia and you've got 2.5 million with your IRA and pension pots and everything else. Important part on this. If you have more than 2 million, although up to 3.7 million might be excluded from wealth tax in Spain, you still need to file if you have more than, in these autonomous communities, you still need to file regardless. It'll just be a zero filing. So if you have more than 2 million of assets and you live anywhere in Spain, even if there is no wealth tax owed, you will need to make a filing. Critically, again, Spain views wealth and all these things individually, not jointly. So this is to do with your individual assets. Critical things, if you're listening in on this, if you have, for instance, pension plans or IRAs, 401ks, SIPs, depending on what jurisdiction, those are individual. Investment accounts, properties, that can be joint or individual, depending on how it's listed as an asset. Next slide. This is a rough idea of the rates. So if you see that, let's say you had 1.25 million of assets, you'd be basically broadly in the category which we see of 668,000 taxable, which would have about 2,600 euros of taxes. Because you're 500K tax-free, so 500K from 1.2 million leaves you about 700K taxable. But as you can see, from 700K taxable, so 1.2 million up to 1.3 million, which is roughly 1.8 million of total wealth, your tax actually jumps between 1.3 to 1.8 million from 2.6K to 8.9K. So actually, it's quite rapidly gets more onerous, the wealth tax. But whereas if you're only just over the limit, it's not really much to bother. So if you've got 800K, no property, you're talking about an 800 euro tax. That's not enough to choose where you're going to live. But as you go up the scale, it can be significant. Next slide. Now, other relevant taxes, things which people are unaware of. Inheritance and gift tax. In Spain, there is a tax on receiving inheritances. There's a tax on receiving gifts. Now, if you own property in Spain or anything else, and you live outside, even if the heir or anything is, there is a real obligation based on having the assets in Spain should somebody pass away or somebody getting gifted. This includes gifts between spouses, which is why it's very important to plan before making these gifts. What are other things in relevance to this? As an example, in Catalonia, if you notarize a gift and it's given to children, grandchildren, spouses, the maximum tax is 11%. It ranges from about 5 to 11%, with a tiny multiplier above that in certain cases. However, if you give the gift without doing a notarized document at the side, the tax can go up to 32% for no other reason than the notary hasn't been paid. So it is very important when you're dealing with inheritance or any significant inheritance or gifts to deal with inheritance and gift tax filing. Now, this varies by autonomous community. In Madrid, in Cantabria, in Valencia, there's a 99% exclusion which has been applied on gifts and inheritances if it's to children, spouses, or anything else. So if you've got anything on this, be aware that this these tax filings are not at the end of the year. They have to be done usually within 2 months of the inheritance or gift date. And if you're planning a significant gift, it's really worth having a pre-conversation about that, particularly because there are certain carve-outs, such as if you receive a gift towards buying your first property, there are potential 95% exclusions from the gift tax and other things which are really worth planning before you make any of these assignations. VAT we've already touched on. Property transfer tax, big difference if you're coming from the US in this case, and from most parts of the world for how large it is. In Spain, the average stamp duty is 10% on a property and about 2% fees to the land registry and notary. So the property transaction tax every time you buy or acquire a new property is very high. What does this mean? On average, properties transact hands in Spain every 60 years compared to every 3 years in the US. Okay, so don't necessarily rush into buying a property in Spain. Be aware of these property transaction tax can lock you in. There is not a property ladder in Spain. It's not how it works. Okay, I'll skip. I know I haven't got too much time, so I'm just going to go through the next slide. So next slide, please. Very quickly, if you're self-employed or have a limited company, next slide, please. These are the deadlines and the different stuff you need to file. For income tax, you need to file the Modelo 130. This is the 20% prepayment quarterly tax if you're self-employed. VAT, Modelo 303. Now, if you are just exporting business-to-business services, you do not need to pay any VAT, but you can reclaim VAT, such as Elliot's co-working, where if he's paying 121 euros on his co-working, the 21 euros of VAT is reclaimable directly from the Spanish government, and the 100 euros is deductible as an expense. Depending on how his co-working services are being done, they could do things a little more complex, and they could be doing 100 euros minus 15% for income tax withholding, plus 21% for VAT. So one thing which is slightly weird in Spain is for certain services, you will find that you will get a bill which will come 100 euros minus 15 euros for income tax withholding, plus 21 euros for VAT. That 15 euros of discount is the fact that you need to pay on behalf of the other counterparty the income tax on their behalf of that 15%. And there's a separate filing which you need to do on that on a quarterly filing. The reason for this is the Spanish government want to make sure that both sides are responsible for the transaction and for paying some of the taxes on the transaction to avoid fraud, basically, because there were too many people where one side wouldn't declare. So they make both sides responsible. So if you ever see you get a receipt which has income tax withholding, IRPF as a discount, remember this means you have an obligation to file taxes in regard to that. Okay. Then at the end of the year, you've got annual income tax returns, annual VAT summaries, and the annual information statement, Modelo 180 and the Modelo 190. Next slide, please. Finally, as I said, getting onto the brackets, if you are employed, these are the broad rates that you see, except from 0 to 7,500. In practice, there's a tax-free allowance, which pretty much applies. But then these are the average rates across Spain. They vary very slightly, but broadly, you can see how it quite quickly escalates, and particularly from about 35,200 upwards, we're looking at about a 37% rate. And then critically from about 60K, we're looking at 45% plus in taxation. So this can be quite steep compared to other jurisdictions which you may have been used to. Although this will shock many people listening, Spain is actually still a lower taxing than the average in Europe. Next slide, please. So, as we were touching on VAT previously, the normal rate of VAT, if you're charging, let's say you do, I'll go on my yoga example. So let's say you're doing a live yoga class. Let's say I was doing a live yoga class and I'm physically in the UK at the moment. If I do a live yoga class for you, Elliot, on this thing, and we're doing a live session, and you're a consumer and you're stretching and everything else, you will this will be considered that you have come and flown over to the UK for this yoga class, and therefore VAT would be determined by my country, not yours, and so it'd be a VAT service. However, so let's say I was in Spain and you in the UK. Let's switch positions in this one. So it would be a 21% fee. No, let's switch it around. Elliot, you're doing a yoga class and I'm listening in. So Elliot's doing his yoga class and I need to pay plus 21%. It's as if I got on a plane and joined Elliot in Barcelona. Let's say Elliot records material and records a good stretching guide for the yoga class. Well, now this is the same as if I had bought a DVD in the UK. So therefore it's taxable under UK sales tax and UK VAT, not on Elliot's Spanish VAT. So instead of paying 21% IVA in Spain, it would be 0% in Spain, but it would be 20% over here. Let's say alternatively, Elliot was making yoga plans for my new yoga studio here in the UK. That would be a business to business export and therefore would be 0% rated. And then on my side, as it's not a consumer ending consumer, it would be 0%. So this is the nuances where, depending on the type of service you are, there are different ways in which VAT applies. If you're simply doing contract work for overseas businesses, very easy, 0% rate exports. If not, it might be worth talking with a tax advisor just for a couple of questions. Next slide, please. Now, when are the obligations? Quarterly taxes, April, July, October, January. Annual taxes, you've got January, February. This is for limited companies. January, February, and July is when you have to do the corporation tax filing. If we've got limited company questions, I'm going to defer that for when people go with questions, because I know we're running a little bit on time. Next slide. Tax deductions. So what tax deductions are available? So if you're self-employed, in general, the rule of thumb is, if you explain this to someone in a bar and they thought that this is a valid business expense, and they thought, oh, that's clearly a business expense, your web hosting, your cost of your office space, the laptop you use for work, your kids' piano lessons clearly are not going to fit in here. If you bought a personal TV, probably not going to cut the mustard. And here's a really interesting one. Utilities are deductible up to a maximum of 30% of your home utilities if you use a home office. But for instance, your internet in general is not viewed as deductible. Why? Because internet cost does not vary based on use. So what they say is, everyone has internet in their home nowadays for their personal use. So there's no additional cost based on that. Finally, you've got a couple of other areas. So professional services, your personal social security payments, anything which is clearly covered. One of the areas the Spanish government tends to be a bit more flexible on is if you've got overseas expenses to do with business trips or anything else. However, there are restrictions and caps on maximum claims. For limited companies, it is very, very similar. The only difference is the Spanish government in practice gives you a bit more leeway on how many expenses you push through, because for some reason they view them as more significant entities. It's a little bit weird, but that's actually, according to the tax code, it's the same. It's just in practical implementation, it's different. Next slide. Oh, last thing on deductible expenses, super important. If they are within Spain expenses, they must have the NIE or NIF of the buyer, and the NIE or NIF or DNI of the other side, and ideally the address and name. Okay, very important. The Spanish government love eliminating expenses. Next slide. So now we've got onto the bit on questions and everything else. The only last things I'd like to add within this of what might be relevant, because we are coming up to tax return season in April to June, and we do have the Modelo 720, which is due by March 31st. What tax breaks are available? You may have noticed we didn't go through too much. Why? Because actually tax breaks are not that extensive in Spain. You might be used to lots of deductibles back in your home country, but actually in Spain, they are limited. Where are the areas where there are valuable tax breaks? One, if you invest in a startup in Spain, you can get 50% of what you invest in a startup, which is a registered startup, early stage, first 3-4 years. You can get 50% of whatever you invest straight off your income tax bill. So you invest 10,000 as an angel round in a startup, you'll get 5K off your tax bill. If you have lower levels of income and you are below 30 and you've got rental costs, those can be pushed through. You can get part of your rent deducted for tax purposes, but this is only about 150 euros. If you have children or if you have any form of disability, this is handy and useful. Outside of that, there's a few things to do with making your home more energy efficient or electric car purchases. But beyond that, honestly, they're not mostly useful. The most useful thing for most of you will be if you have withholding tax on overseas investments, which you need to make sure you claim. That's the critical thing which people miss out on and is worth pushing through. So I suppose at that point, Elliot, please let me know what questions, what everything else. And if you want to go on to the next slide, we can share there should be a QR code, I think, on the next slide.
Awesome. Thank you so much for that. And again, looking at how it's evolved since last year, I don't know if it's gotten better or worse, but there's certainly evolution in the way the tax system works. What I'm thinking is I'll quickly run through my part on the pensions, and I'll put the QR code back up, and we can.
Perfect. Sounds great.
Awesome. We'll do a whole Q&A thing. So again, Louis, thank you so much for that. Let me just share my my presentation. In the future, we'll merge these two together, not have to do this, but every year is about evolving and doing things better. So there we go. So yeah, thank you again, Louis, on that. What I want to quickly touch on are some of the pension plan opportunities and how they work here in Spain. And again, these are sort of evergreen things where you don't necessarily need to wait until a certain season to start working with a pension plan. Rather, it's something that can happen either time. But once you get your taxes taken care of, you can start thinking about these very interesting to varying degrees of interest in terms of building out your wealth plan and your financial planning down the road. So here in Spain, and like in most other countries, there are different pillars for pension planning and pension savings here in Spain. You have the first one, which you have all over the place, state Social Security pensions. As Louis was saying, we have to pay into Social Security, whether as an employee or as an autonomo freelancer, and this acts as a credit for us that we have for our pension down the road. We have employment-based pensions, elective ones, and then the ones that we make ourselves. I'm going to quickly just touch on the 4 different ones. So the first one is state Social Security. It's a pension from the state, and as we have covered, these are mandatory. There's no way to get around this without breaking the law, i.e. not paying your taxes into the system. And we're not going to touch on that stuff because we should all be really good citizens and pay into the system as we can, because the idea is that contributing to Social Security opens up a lot of other benefits, not least healthcare and our pension payment from the state. Here in Spain, the majority of your pension, or at least the way the system's set up, should be coming from the state. In practice, that's really not the case. You should always be planning ahead, but it's not like in the UK where your first pillar pension is a few £100s a month and payouts. Here, it can range from a minimum of, right now, from €1,500. Well, the very minimum is around 900 a year, and it can run up to about 4,000 depending on how much you put in. Now, I don't think anyone on this call is about to hit retirement, or at least to hit the retirement age here in Spain for the pension, which is either 65 after contributing to the system for 39 years, or 66 if you haven't made those full 39-year and 5-month contribution. So who knows what that's going to look like down the road, but effectively what happens is every month that you pay into Social Security, you get a credit, which is an IOU from Spain somewhere down the road, where they will pay you out your pension plan. The more you work to it, the more you contribute, the more you'll have when you reach retirement. If you are not planning on sticking around Spain for your entire career, generally you're going to be entitled to the credits that you've earned. How that works in practice will really depend on where you wind up at retirement within the EU, and I assume the UK still has this in place. I haven't seen anything where they haven't. There is a very good system to recognize each other's credits. So let's say you've worked in Spain for 10 years, you decide to go to Belgium for 15 years, then back down to Portugal to get away from the rain. Well, you collected these pensions in different places, and when you hit the retirement age of each country, you'll be entitled to a percentage, effectively to the credits that you've earned, which would be added up with constitute your entire first pillar pension income. There are also bilateral treaties outside of the EU, and so, for example, with the United States, Spain and the US recognize each other's contributions. So if you live in Spain and you're a US citizen and you've contributed here, you move back to the US. When you're doing your retirement planning in the US towards the US Social Security, they recognize the amount that you've paid into Spain as part of the contribution towards the US system, and they have a way of ensuring you get payment for that, and vice versa. It's actually really good for Spanish people who've worked in the US and come back over here, because you get more out of the US system than Spain, but that just goes down to the US having a bit more wealth. After that first pillar pension, which you really can't avoid, and you just need to assume that you're paying into it and you're earning the credits that you have your second and third pillar pensions here. So the second pillar being the ones that you get from employment, the third ones that you can choose yourself. And interestingly, here in Spain, there's a €1,500 tax deduction that you can apply to your tax bill to lower your income, your taxable income amount. That would, depending on a few different factors, could be interesting for you from a tax and pension planning perspective. So the second pillar is really the employment-based pensions. And these are things like a SIP in the UK, a 401k in the United States, or any sort of pension plan that you're getting through your employer. And what's very important about these is that you don't have too much say about what's going on for them. So if there's any Americans on the call, generally from the U.S. perspective, having a Spanish-based pension from your employer, they look at it as a 401k and not as a passive foreign investment company where you'd be filing a lot of complicated tax returns and paying potentially up to 50% in the United States. No, it's really seen as just a retirement pension plan. These have been around for a long time, but back in 2023, the Spanish government changed the pension rules to try to encourage more companies and even individuals to get a supplementary pension because they kind of realizing that Spain might not be able to meet their obligations down the road for their first pillar pension. And sure, what these are called qualified employment pension plans. As an employee, you can contribute up to 1,500 euros a year out of your salary, and that will be taken automatically from your paycheck, and you'll be able to deduct that amount from your gross income amount when you go to do your filing. And what gets really interesting here is that employers can effectively overmatch up to 8,500 euros per year, and they receive a reduction on their Social Security cost. Effectively, if you have an employer who's willing to do this, you could be getting 10,000 euros a year towards your pension into a plan, and depending on what the plan is, it's really not a bad investment. Now, the issue is a lot of the pension plan providers, they take a very conservative investment strategy, so maybe they're making 3-4% annually, which really isn't that great, and then also they charge a fairly hefty fee to do so, so the net returns sometimes won't even beat inflation. So it's really important to, again, look at what the plan that's being offered by the employer is and see how that fits into your overall planning. The other side of these things is that they're not very transparent. We've had some coaching customers over abroad and here in Spain who have shared these with us, and we can look through these documents. Something we love to do is dig through these very technical looking financial docs to understand what's going on. And oddly, the ones for the employer pension plans are some of the most opaque that we've seen. So it's really important to get that information from the plan provider. Your HR might be able to assist you with it. But either way, it's very interesting if your employer offers it and the fees and the performance seem all right. Crucially, these are not mandatory, so employers aren't really forced to invest in them. Actually, many don't because they see the cost of contributing to a plan as much higher than the actual Social Security benefit. Generally, where you see them is in major companies, or you'll have like some collective group who will open them up for their workers. So, for example, one of the largest construction companies in Spain, they're probably the biggest users of this, and they have tens of thousands of employees on it, if not hundreds of thousands. Interesting as well, if you're self-employed, you can also take advantage of similar reforms. So Spain realized that self-employed people really don't have it easy here, especially when it comes to savings. So they've actually created a pathway for you to participate in something very similar to an employer-based pension plan, specifically for autonomous or self-employed. And in addition to the 1,500 euros that you can use from your overall credit, there's another 2,050 euros that you can deduct from your operating income if you participate into these plans. And again, based on how efficient you are from a tax perspective, and this is something that really an entrepreneur days would be able to tell you far better than we could, this could also be very interesting, especially if the plan has these low fee, higher performance characteristics. There's some out there that can indeed be quite useful, but it's really important to look at the provider, look at the documents, and really do your research on there. Aside from that, you also have your third pillar elective qualified plans. So these are plans that you'll see offered by usually banks or insurers. If you go out to like Sabadell, La Caixa, wherever you do your banking with, they'll probably try to sell you one of these pension plans. And these also come with that 1,500 euro a year tax benefit. But the difference between those and the employer ones is these are fully elective. You choose whether or not you want to take it. It's up to you to decide how long you want to stay in it. It's really up for your discretionary choice to make this one. For the Americans who are here, these actually aren't really recognized by the IRS as a employee-backed pension plan, so these would technically fall under these more onerous reporting rules. But if you're not an American or you're here for a really long time, these could technically be interesting. In short, really what they go down to, it's the same as the others. It goes down to the fees, it goes down to the performance. But crucially with this plan or any of the employer-backed ones is that you get locked into these for at least 10 years. So if you start investing in one today, you can't start taking the money until 2035, March of 2035. So if you're not planning on sticking around Spain for a long time, these could potentially be more trouble than they're worth. Why? Because if you move to another country, first, you're not going to get the tax benefit of participating into a Spanish pension plan. Second, because they're more expensive than other alternative investments, you're going to be stuck with an asset that's not going to be performing as well after fees. And throw in the fact that many of these are just very conservative, it gets even more complicated and less attractive. So this is a question you want to weigh out. On top of these individual pension plans, there's some targeted and insurance-linked savings accounts, Plano Oro 5, CELAP, CIAP, and PS. Pretty much these are short-term savings plans linked to insurance. There's some tax benefits in there, but you have to get locked in over a certain period of time. From our point of view, unless you have a very specific goal around these, they're probably not worth the trouble of investing into. But again, it's an option that you might want to explore. Again, I've touched on this just briefly before, but again, like if you're going to be looking at these, the things you want to keep in mind is like they're not transparent. Transparency really matters. You want to see where your money's going. You want to understand how it's managed. They underperform other investments just due to the nature of A, they're conservative, and B, there's fees behind it that eat away from the net return. They have this lock-in period that, again, if you're not here for the long run, it might not be worth it to you, at least compared to other alternatives. And really, they're just not as portable as other sorts of investments. On that, there are fourth pillar pensions, which are your personal investments that you can look at. These could be any sorts of investments, individual stocks, investment funds, the cryptocurrencies, real estate, whatever you feel like you want to put your money in to grow your wealth. That's more or less for up to you to decide. Generally in Spain, there aren't really any tax breaks for those. There are special rules regarding mutual funds, CCAPs, as they are technically called, which state that here in Spain, you can switch between mutual funds and you don't have to pay the tax on any gains until you sell one of those funds. So I could today start buying into a mutual fund, a CCAP that invests in European defense and one in like global stocks. And as I get closer to retirement, I could shift that into something more focused on a conservative and certain return like bonds and money market funds. And really until I would sell that overall asset, I wouldn't have to pay the tax on the gains I made before. Now, there's some confusion where people might think, I don't have to pay the gains at all. That's not the case. It just gets deferred. You don't get this sort of tax credit with an exchange traded fund, which is very similar to a mutual fund, but there's some key differences. However, again, like these can sometimes be limited just to Spain. So if depending on the funds you get, it might be difficult to get out from under that. Actually, I know we're a little bit short on time, so I want to open it up to Q&A. Just to say, I know we touched on this briefly. We're going to be doing a lot more content on pension plans, including a guide that we have prepared for a course that we've just building out. I'll just show you what we have because I have this obsession with writing. This is everything we have on pension plans that's getting turned into a course. The fun part is writing it. The hard part is filming it. But that's going to be coming out really soon. So all of you who are on the webinar today will receive a link to access that as soon as it's out. But yeah, I thought since we have a few minutes left, if there are any questions on taxes, on pensions, feel free to ask away in the chat. Assuming you all can chat. I hope you can chat. Let everyone send a message. So.
While waiting for any of them to come out, I'll launch a question from my side, which I think might be interesting for the audience. On the SICAVs and everything else, what do you see in terms of mutual fund fees versus ETFs? Because one of the big trade-offs when we look on tax saving is the fact that it's all very well and good that I defer a bit of my capital gains, but if I end up paying a higher fee rate, is it really worth it for me? What do you see on that side?
A very good question. And a lot of times, like it will depend on the mutual fund. So if you're going for one of these big international ones, like from Vanguard, the fees are very low. They're very competitive because Vanguard is competing on the international market. Whereas if you go to some Spanish bank or fund issuer, there's a very good chance they're going to charge easily multiples of what you know of what you'd see from Vanguard. It's not uncommon to see 2-3%. And again, if like maybe their target return is like 5% before the fees, you're looking at a net return of 2%. That's just it's not worth the trouble. And on top of that, many of these coming from the Spanish banks are only registered in Spain. So that means if you leave Spain, you're going to have to continue to keep the asset here in Spain, and it could wind up in a situation where you're in a country where you have to declare a foreign asset, much like you'd have to do with a Modelo 720. You're doing an extra filing in that country you're in.
Interesting. It's one of the issues for people who are watching. So my background used to be in investment management, but I can't actually talk directly on investments. And one of the classic issues we face with clients is the trade-off where we're dealing with exactly what Elliot just touched on there, which is, hang on a second, does this actually make sense? Because the fees, the Vanguard offer might be very good, but the add-on fees which you might get from a BBVA or anything else hidden in that, you might be paying 2%, which if your investment returns are only 5% a year, 2% fees is like having a 40% tax. So lots of these different parts on capital gains. In terms of the insurance plans, which you were looking at contribution, because the contributions on the pension plans, there is a genuine interesting pie, and there are some providers who've gone a lot cheaper on those fees. And I think gradually we're going to see more financial products developing. And that's a big tax saving if you guys are looking to start building up pension. You're going to be here long term. If you're going to be within the European Union, if you're going to be within the UK, there are ways to port them between each other. But if we look at the PIAS and the insurance products, could you give a little bit more flavor on the issues that you've seen there? Because the big tax saving they've got is that you're only paying 1% on the growth within them, and they've got lots of discounts on that. However, the contributions are post-tax or pre-tax when the money goes in? What was the structure usually of the insurance products?
It's generally your post-tax money that you're putting into it. Well, it would depend on the insurance products, right? So for the ones that are elective, you're going to go in there with your post-tax money. If it's an employer-based one, they're going to just deduct it automatically. You're not going to see it. But as these third pillar ones, you're going to have to manage that yourself. So you're supposed to get a document from them. You take it to your tax people and they fill it out. But my bigger issue with a lot of these like insurance-backed ones is that the performance just isn't very good. And what you really want to weigh out is the performance of this product really worth the tax benefit? And another part about this tax benefit is it's not cumulative. You can't just say, I'm going to put 1,500 euros into my employer-backed pension, 1,500 euros into a pension plan sold by the bank, and 1,500 euros from one of these like insurance-backed ones. No, it's you have to do, you have that 1,500 euros, and it's up to you to figure out how to divide it out. And all things being equal, these products just, they don't scream, hey, this is a good investment, unless it's a very specific case. And usually what will happen with these is that financial services companies, or there's insurers or banks, they'll offer them because they get a commission on the sale. It looks good for them because they have all these fancy products, and they know that we as consumers don't know any better. So we think, oh, hey, I got a tax benefit and my money's safe in this investment product. But actually, when you dig underneath the surface, you see, well, this is kind of a load of garbage. But again, it's a disadvantage. I think it's a bit like the notaries, where they have this sort of like natural advantage that people just know they exist and they have to exist. Banks are the same way, and there's not a whole lot you can do about that. I think the notaries are worse.
Yeah,
in my experience.
but it's a classic issue, right? When you've got a protected market, the Spanish break European financial regulatory rules on certain abilities to block and protect their Spanish banks from competition.
Yep.
And that unfortunately can lead to a poorer product offering. So if you were going on almost a summary, the big thing for you would be saying that the pension plans are interesting. And if you can get employer contribution ones, these genuinely are worthwhile. But outside of that, it's really looking at the investment side. And that's very similar to what we've seen on the tax side. I see so many people coming in looking to save the taxes. But even when you think of the withholding tax that we were talking about before, if you're paying 15% withholding within a PIAS, you're not really saving much money anyway on the growth of those investments. And people think they're saving money on taxes, but actually they're paying 1-2% in fees. And we also know, for people who are watching in, quite often you'll find that some of these insurance products spend a lot of money so that they can go and sell them into big corporates, that they're going to have an insurance-based plan where somebody can have an additional pension saving. when really it would have been better that they just got that cash and put it into stocks and shares
Exactly.
themselves.
Exactly, but we think, hey, insurance, that sounds good. It's secure. I need insurance, but it really, no, it depends on where you are in your life. Like these insurance products, especially the life insurance backed ones, can be much more interesting when you're closer to retirement. And you think, all right, well, I want more guaranteed income, and then there's some tax benefits towards leaving it towards your spouse. But for all of us, well, far away from retirement, it's better to grow your wealth, your retirement fund as aggressively as you're comfortable with, so you can make a much better decision when you get to retirement about how you're going to manage that.
One of the things I just realized is actually in the comment feed, the others are not able to put comments. We just did a quick test.
Ah,
And
shit.
so
Excuse me.
this is the issue which may have occurred for the Q&A. I'm going to make a suggestion. If we can't get that active, just aware that with time and everything else of the people being here, if anybody wants to write into Elias or write into us, I'm going to drop in a little email here where we can basically field small questions. If you've got a couple of small tax questions, we can give you some written responses to a couple of questions you might have. If not, if you look in the comment feed, you should be able to see a couple of not comment feed, the messages board on this side. That you should have different things. And there's an email where you can get my colleague Laura Rojas, where we can respond to short tax questions. If you need something which is more significant, we're going to book in on specialist. There's a specialist consultation link to book in with me, and there's also a link to do a tax return help on this. I'll just see, Elliot, if you can get anything live. If we've got a couple of minutes, just to see if we can fit anything.
Let me see if
If
I can
not,
do
I will need to disconnect in about 5 minutes, unfortunately.
Let's see, it's very strange. It says, let everyone send messages on my dashboard. But, you know, it's literally like 5 years ago this week, everything went online and remote, and I still can't get this tech. I don't know if that's a user thing on my side, but otherwise, yeah, I think it's a good idea to reach out to Laura. I chat with Laura quite often. I always enjoy emailing back and forth with her. By the way, I have a question for you.
Yeah, let's go.
So Beckham, we didn't really talk about Beckham.
We did not talk about Beckham. That is so relevant. Please go and ask the question you were going to ask.
Beckham is really cool because it's if you haven't been a tax resident in the past 5 years and you move to Spain, you're eligible. If you're an employee, you're eligible for a flat rate of 24% tax on your Spanish sourced income, and you don't pay any tax on anything happening abroad.
On your passive income. So this is one of the really interesting things to be careful of. So Beckham's Law is a special tax regime, which people will have heard, where you pay 24% flat rate of income tax, plus then you pay Social Security and the rest as normal, because you're effectively treated as non-resident. Now, the interesting thing with this is, what does that mean? They view you as tax resident in the Seychelles, but as if you worked in Spain for 365 days a year. So any earnings you make under Beckham's Law, whether it's self-employment or employment earnings, wherever it is in the world, are taxable in Spain. This is one mistake where people think, hey, I've got an LLC or an S-Corp overseas, I'm making lots of profit. As an S-Corp and an LLC are disregarded entities, their profits are self-employment earnings, which are viewed as if they are earned in Spain where you're living. However, if you've got investment assets, if you've got assets above the wealth tax or anything else, those are ignored. So if you've got rental properties overseas, you only pay the withholding tax in the country of origin, and you do not need to pay any tax in Spain. This is a tax break which is available for 5 to 6 years, depending on when you arrive, and can be a fantastic opportunity. This is available for employees, people who are employed overseas and get posted to Spain as remote workers, but only if you're an employee and not self-employed. Entrepreneurs who come with the entrepreneurship visa, people who move and take the role of the director of a company, providing it's not a wealth management company, if it's not basically a passive asset holding. It needs to have true economic activity. You can't just say, I'm putting a couple of million into property and therefore I shouldn't pay tax on all the assets I have overseas. This is incredibly useful if you have 55K or more of income, or if you have less than that but have significant overseas assets. This is the particular area which it gets very interesting, because the shielding of your overseas assets from investment taxation can be super useful, particularly when there are lots of countries which apply no withholding tax on dividends and no withholding tax on income.
I think it's a great deal. Like if we get questions about people moving into Spain from abroad, and the first thing we say is like, well, if you moving here and you can be employed and you haven't been here the past 5 years, Beckham, like 100% get on Beckham. But it's this like loophole where autonomous, and we have a lot of people working remotely who have to become freelancers. They really get, they get the business end of the stick on that one.
Yeah, where they can miss out. The one thing which is interesting is there is a possibility if you've got a more significant business to set up a limited company in Spain and thereby get access to Beckham's Law. One of the creative ones which people are doing nowadays is taking over a cafe, bar, restaurant, small wine shop where they put themselves as director, invest 50 grand, and then shield their overseas assets. They might be in practice basically retired, but if they're part-time working with a bookshop and they've got employees and staff, they've got real economic. Now, this is, of course, valuable for those who have significant existing wealth, right?
Yes.
So if you are looking at the type of significant existing wealth, please book in for a consultation and we can discuss this in detail and really see what makes sense for you.
Excellent.
Yeah.
What if you have employee stock options from another country and you exercise them while here?
Really interesting. So it depends how they've vested. So employee stock options are an absolute nightmare. Why? Because there are different types which are viewed of if they've been awarded and you pay tax to the point where they are vesting. So let's take the example of restricted stock units. Super easy. They've already vested. When you sell them, it's an overseas asset capital gain passive. So a restricted stock unit is a type of stock or share where you receive a chunk overseas. This is not an option. An option is the right to purchase. Quite often, right to purchase options are deemed as having been earned previously. And then when you realize them, they are often taxed with an advantage rate of the country of origin as capital gains income or as potentially regular earnings at the point at which you activate them or sell them. Now, it really depends on the option plan of whether it gets approved within Spain. In principle, if the option is earned overseas and is considered earned income before you move to Spain and then you're under Beckham's Law, it can be deemed that, and it vested prior to you getting to Spain, that it was only taxable in the country of origin, and you still need to go back to that country of origin. What happens quite commonly with equity option plans is you often see that companies will cancel them and reissue them upon the moving of new jurisdictions, because it can get into a really messy situation where you could be deemed as being double taxed. So if you have significant equity option plans, that would be another one where I'd say it's worth booking in. If you've only got a couple of thousand, it's not worth it to be spending money on a tax consultation on an eventuality that you don't know which will necessarily happen. If you are an equity option plan which is vesting while you are in Spain, they are not taxed until the point of realization, but then they are taxed as labor income. So one thing which is quite common you see in Spain is instead of equity option plans, quite often you see a thing called phantom shares, which is just a commercial contract which pays you the equivalent of an equity exit, basically.
Yeah. Why do things easy when you could, do things in Spain? I guess I don't know.
Exactly.
Yeah. Also, I think we're a little bit over time, but Louis, thank you so much for chatting with us and sharing this excellent info on taxes in Spain. Again, I will be sharing out the replay this afternoon once we get it. Apologies for the comments. We'll figure that one out for the next one. But thank you all again for joining us, and I wish you all a wonderful afternoon.
Have a great day, guys. Bye.